As the echoes of the 2023 banking crisis reverberate through the financial landscape, America's largest banks find themselves ensnared in a complex web of challenges. The specter of bank failures from the previous year continues to haunt the sector, with the Federal Deposit Insurance Corporation now taking significant measures to recover losses incurred during the collapse of Silicon Valley Bank and Signature Bank. The aftermath is casting a dark shadow on the industry, exposing vulnerabilities that have far-reaching consequences for the nation's economic giants. Let's see what exactly is going on. In November, the Board of Directors of the Federal Deposit Insurance Corporation officially approved a final rule aimed at implementing a special assessment. This assessment is designed to recover the losses incurred by the Deposit Insurance Fund in safeguarding uninsured depositors during the closures of Silicon Valley Bank and Signature Bank. As mandated by the Federal Deposit Insurance Act, following the systemic risk determination declared on March 12, 2023, the FDIC estimates that approximately $16.3 billion of the total cost related to the failures of Silicon Valley Bank and Signature Bank pertains to the protection of uninsured depositors. Having taken into account public comments on the proposal and conducted a thorough analysis of relevant statutory factors, the FDIC is adopting the proposed special assessment as final. The final rule includes clarifications to enhance transparency and a modification allowing for corrective amendments to estimated uninsured deposits during the FDIC's review of an institution's reporting methodology. FDIC Chairman Martin J. Gruenberg stated, "The final rule applies the special assessment to the types of banking organizations that benefited most from the protection of uninsured depositors, while ensuring equitable, transparent, and consistent treatment based on amounts of uninsured deposits." The final rule also promotes maintenance of liquidity, which will allow institutions to absorb any potential unexpected setbacks while continuing to meet the credit needs of the U.S. economy. According to the final rule, the FDIC will implement the special assessment at an annual rate of 13.4 basis points, starting from the first quarterly assessment period of 2024, that is, January 1st through March 31, 2024. The invoice payment date is set for June 28, 2024, and the collection of special assessments will persist for an expected total of 8 quarterly assessment periods. The special assessment base is determined by an insured depository institution's estimated uninsured deposits for the reporting period ending on December 31, 2022. It is adjusted to exclude the initial $5 billion in estimated uninsured deposits from the IDI or at the banking organization level for IDIs, within a holding company with one or more subsidiary IDIs. Approximately 114 banking organizations are estimated to be subject to the special assessment. Meanwhile, the biggest banks are facing massive losses from the last quarter of 2023. Citigroup disclosed a $1.8 billion loss for the fourth quarter, attributing it to charges related to replenishing a government deposit insurance fund and executing an extensive internal reorganization. The loss was also influenced by setting aside funds to cover currency risks in Argentina and Russia. The third largest U.S. lender reported a loss of $1.16 per share for the 3 months ending December 31st. These results were impacted by $3.8 billion in combined charges and reserves detailed in a filing on Wednesday. Quarterly revenue decreased to $17.4 billion compared to the previous year, while Citigroup's 2023 revenue rose to $78.5 billion year over year. Its net income declined to $9.2 billion. In the fourth quarter, Bank of America experienced a reduction in profit, impacted by $3.7 billion in one-off charges and a decline in interest income as the bank incurred higher expenses to retain customer deposits. Shares of the second largest U.S. lender dropped by nearly 1.2% in afternoon trading on Friday, following the announcement of net income at $3.1 billion or 35 cents per share for the 3 months ending Decanter 31. This compares to $7.1 billion or 85 cents per share in the same period a year earlier. JP Morgan Chase initiated the earnings season with a significant miss, primarily attributed to peculiar accounting practices. The bank reported a 15% decrease in fourth-quarter profit from the previous year, totaling $9.3 billion, considerably lower than analysts' expectations surveyed by FactSet. Earnings per share stood at $3.04, falling short of the estimated $3.35 according to FactSet. Despite the quarterly performance, it's important to note that JP Morgan achieved its most profitable year on record. The bank recorded a 23% growth in revenue to $158 billion in 2023, and profit increased by 32% for the year, reaching $49.6 billion. So what explains the discrepancy? Blame the regional banking crisis. The cleanup efforts following the collapses of Silicon Valley Bank and Signature Bank last spring incurred approximately $23 billion for the Federal Deposit Insurance Corporation, with a significant portion of the bill borne by larger banks. JP Morgan's profit faced downward pressure due to a one-time $2.9 billion charge linked to the crisis. Excluding this exceptional payment, JP Morgan reported earnings closer to $3.97 per share, surpassing estimates. As a key indicator for Wall Street, JP Morgan's experience often reflects broader industry trends, and other banks encountered similar challenges. Bank of America, for instance, paid a $2.1 billion FDIC fee related to the crisis. Despite reporting fourth-quarter earnings of 35 cents per share, falling short of FactSet estimates of 53 cents per share, the bank indicated that, excluding one-time fees, earnings for the quarter would have been approximately 70 cents per share. Citigroup, too, contributed a $1.7 billion fee to the FDIC and reported a loss of $1.16 per share for the fourth quarter, below earnings estimates of 11 cents per share according to FactSet. Citi mentioned that without one-time costs, fourth-quarter earnings would have been 84 cents per share. Citi faced additional costs impacting its results, including an $880 million loss in Argentina and $780 million in restructuring expenses. A spokesperson from JP Morgan clarified that FactSet and other analyst estimates did not incorporate the special fee in their forecasts. The spokesperson emphasized, "To be clear, our net income was reduced by $0.74 per share because of the Federal Deposit Insurance Corporation's special assessment. We reported EPS of $3.04, which may initially look like a miss, but many analyst estimates did not include the $0.74 per share we paid to the FDIC." JP Morgan's shares surged 27% in the previous year, marking the highest performance among all large banks in the United States. The stock showed a 1.8% increase in pre-market trading. The 2008 global financial crisis was largely attributed to banks' inadequate monitoring and control of liquidity risk. In response, global regulators, notably the Basel Committee, devised comprehensive reforms to address shortcomings within the pre-crisis regulatory framework. The Basel Committee is currently in the process of implementing the final component of the Basel 3.1 standards. The overarching objective is to establish a resilient banking system, ensuring market participants maintain sufficient capitalization and liquidity to absorb risks during challenging periods. Basel 3.1 standards have introduced various risk management measures, including the liquidity coverage ratio and risk-weighted assets, aimed at enhancing resilience against short-term liquidity shocks. The liquidity coverage ratio mandates financial institutions to hold a proportion of highly liquid assets, ensuring they possess adequate capital preservation to meet short-term obligations in times of significant liquidity stress, typically over a 30-day period. This requirement is assessed through a generic stress test. Risk-weighted assets calculations play a crucial role in the risk-adjusted capital ratio, determining a bank's ability to operate under stress. This measure strengthens bank capital requirements by evaluating liquidity and leverage based on the level of risk a bank assumes, ensuring it maintains sufficient capital to mitigate such risks. These changes aim to enhance the comparability and credibility of risk-based capital ratios for firms and their products, contributing to a more robust and resilient financial system. The banks have also begun to make internal changes to maximize efficiency and keep expenses as low as possible. Last month, Chief Financial Officer Mark Mason indicated that Citi anticipates completing its overhaul in the first quarter of 2024, with the objective of reducing annual expenses to a range of $51 billion to $53 billion. In a move to streamline its operations, Citi has announced leadership changes in November, revealing plans to reduce management layers from 13 to 8. Under the new organizational structure, leaders of Citi's 5 major businesses will directly report to the CEO, and regional leadership roles outside North America will be scaled back. Citigroup disclosed plans to cut 20,000 jobs over the next 2 years, acknowledging a clearly disappointing quarter marked by one-off charges that resulted in a $1.8 billion loss. The fourth quarter was very clearly disappointing, CEO Jane Fraser told analysts. We know that 2024 is critical. The bank intends to trim its global workforce, currently standing at 239,000, by 20,000, equating to approximately 8% of the staff, by 2026 as part of an extensive reorganization, according to Chief Financial Officer Mark Mason. Additionally, Citi will exclude 40,000 jobs when it eventually spins off and lists its Mexican consumer unit Banamex in a future initial public offering. The ultimate goal is to achieve a staffing level of 180,000 employees, as outlined by Mason. The unfolding challenges within America's largest banks paint a sobering picture of the complexities and uncertainties facing the financial sector. The aftermath of the 2023 banking crisis has triggered a series of events, from the FDIC's special assessments to major banks grappling with substantial losses in the current quarter. The stringent regulatory measures, epitomized by the Basel 3.1 standards, seek to fortify the banking system against liquidity risks, but come at the cost of substantial adjustments for financial institutions. Citigroup's ongoing overhaul and job cuts, coupled with the struggles of Bank of America and JP Morgan Chase, underscore the industry-wide impact of the recent crises. The reverberations extend beyond balance sheets, affecting employees, leadership structures, and strategic directions. The intricate dance between regulatory measures and the resilience of these financial giants will undoubtedly shape the trajectory of the banking sector in the coming years. As we stand on the cusp of a critical year, marked by economic uncertainties and transformative changes within major banks, the resilience and adaptability of the financial sector become paramount. Thank you for watching.